Hello everyone, Clifford Bennett, Chief Economist, ACY Securities, and a big week ahead. We've got some PCE data in the US and of course Q3 GDP. Actually, I see, as you know, I see constant reacceleration, rekindling of inflationary forces. Doesn't mean it comes in every number, but it could well show up quite clearly this week with that PC data.
Hi traders, and thanks for watching. We'd like to take this opportunity to thank our incredible viewers for tuning into our channel. We would greatly appreciate it if you could hit that subscribe button, as we're pushing for the 10,000 subscriber mark by the end of the year. Now back to the video.
So in the US, US Q3 GDP, it could be the last sort of appearing strong quarter due to all the extreme fiscal spending and all the money that's being pumped into the economy. But the real economy itself is in more trouble, as I've pointed out numerous times, than that aggregate GDP data will be perhaps showing us. In terms of markets, of course, unfortunately, escalation of the latest conflict in the Middle East is actually occurring. What we've had happen in recent hours, I guess, or recent days, unfortunately, is that Israel has attacked Syria's two major airports, and there is very active exchanges going on with increasingly heavy equipment between Israel and Lebanon along that border there. So there is escalation happening. The bombing of Gaza has actually increased, and for both sides, you just have to have a heartfelt prayer that the people of the region can experience peace. What this means for markets, though, I think is, well, I guess there's two forces at play in markets at the moment. One is the reaction to the conflict, the rising geopolitical tensions. China's moved more ships towards the Mediterranean as well. So there is a build-up going on there. Russia has as well. The US, we know, is doing that with their latest supercarrier, the Ford. So geopolitical tensions are definitely rising in the region. The conflict is escalating, but not escalating majorly. But there is increased tensions regarding Iran as well. So I think all of these factors, unfortunately, are factors that support gold. I say unfortunately because you don't really want to be profiting from these sorts of events. So I think gold and oil will continue to be supported. As I said last week, I do see an Achilles heel for oil that I don't really see for gold. Unless the US dollar shoots higher, then obviously gold US dollar could be stable to a little bit heavy for a short period of time. So it's really when investors decide that the US dollar isn't a safe haven because of its fiscal crisis, but perhaps because of really serious geopolitical risk increases, we forget about the fiscal deficit again and we still treat US Treasuries and the US dollar as safe havens. I no longer see them that way, but the market could. So I see, the fiscal deficit and the economic underperformance of the US continuing really undermining bonds as they've been doing. I'm still short bonds, doing very well. Just a small aside, I'm also doing very well being short Tesla, but that's another story we'll address another time. I do think it's a battle of what's the real safe haven here, gold or the US dollar. For the moment, it could still be the US dollar, and then it could still be both. But at some point, I think the US dollar capitulates, but it's probably not during a period of significant geopolitical tension. So this latest conflict in the Middle East could actually delay the capitulation of the US dollar. And remember, I hadn't called it yet. I was just saying eventually there is going to be a capitulation due to the huge, massive deficit and ongoing fiscal spending and the political paralysis that is all causing in Washington is not good for the US outlook. So for the moment, I tend to favor people will be buying the US dollar. People will be buying gold. People will be buying oil. And sorry, I didn't highlight it. the Achilles heel for oil is that OPEC decides that it has a responsibility, if you like, as a good global citizen to perhaps increase oil supply to keep the price down rather than having an oil price crisis on top of the geopolitical tragedies unfolding. So that's oil's Achilles heel. And also, of course, it'll be a little bit under pressure, like gold, from a stronger US dollar. So I do think people are going to be a little bit more cautious. Oil this week, they're going to still be buying, but it could still rally significantly on any escalation, significant escalation, both gold and oil, and the US dollar as well. So very tricky trading there among those three for the moment. For equities, I do see downside. I do see the usual Monday rally. It's almost a very reliable thing. But New York Friday closed very heavily on lows. In fact, I was selling at the New York close, adding to shorts from higher up. I think we are going to see perhaps some sort of consolidation or bounce, but I don't know if it's going to last much beyond today. And even later in the 24-hour clock in New York trading, if not in Europe, we could see further downside for equities. There's no reason I can think of to be buying equities at the moment, actually. But now the caveat to all of that is, and it's a life lesson too, is that we all experience, and something to keep in mind in every area of our lives, particularly acutely when trading and investing in global financial markets, and that is we always have our biggest fall from our point of greatest confidence. So I found myself on Saturday morning, feeling very confident about gold, oil, and equities, and how my portfolio was running, and the direction of those markets. And I caught myself, and I went, you know what? This is the kind of level of confidence that can get a trader in trouble. So the fact that I'm that confident could mean that everyone else in the world has figured out all of these factors as well, and therefore those markets might be running out of steam that I have this strong confidence in. So it's time to just wind back a little bit. So I did wind back quite a bit on oil and gold, but I'm still long, but much smaller positions. And the equity market could rally a little bit because it's seeming a little bit too obvious. But I want to come back to that point that the market closed in New York heavily on its lows. And I think that is the pointer for the rest of this week going through it. I think we're going to have a lot of media headlines around various economic data releases this week, but I don't think they're going to change the overall trajectory. They might create some intraday volatility of equities lower. And I do think gold, oil, and the US dollar could all be stronger again by the end of the week and through the week, but it's a bit of a tussle about which one of those is leading and which one is coming last and which one is in the middle. Outlook for Australia this week, just quickly, local markets here. And by the way, it's a great advantage to be commenting on the US and the world from here because you get to see the forest. So that's our big market advantage. But for the Australian market, I think the Australian dollar could still be under pressure if this US dollar is strong. It'll be helped a little bit by a strong gold price. It'll be hurt by a strong oil price. But so I think overall the Australian dollar will be weak, and I think Australian equities are highly vulnerable to geopolitical tensions, though they could be good for commodities in the medium to long run. I just think the further negative to the global economic outlook does mean that the Australian dollar could be vulnerable, and so could some Australian stocks. I hope you have a good week. Remember, you have all the financial market tools you need to protect yourself first, and then second, make the most of the opportunities that are presented. I wish you a good week. Thank you very much. Clifford Bennett.